evening, everyone, and thank you for tuning in for another Invest Newark Real Estate webinar. Tonight, we have the pleasure of hearing from Roger Johnson, the Senior VP of Real Estate Development here at Invest Newark. Given his professional career and his personal experience, he has a vast amount of knowledge and can give you the complete home buying experience step by step. Without further ado, I will pass it on to Roger.
Hey, thanks, Tracy. Good evening, everyone. Thank you all for joining our webinar tonight for the complete home buying experience. Again, I'm Roger Johnson, Senior Vice President of Real Estate Development here at Invest Newark, and I'm going to be bringing you this information tonight. It's a lot of information, so I hope you're ready. Hopefully you got your pen and paper with you so you can take some notes, but the webinar will be recorded and be found on our website as well as our YouTube channel as well. But before I get started, I want to let you know that it's going to be a little interactive. So, as you drop questions in the Q&A modular at the bottom of the Zoom, Tracy's going to pick a few that are relevant to the steps that I'm on, and she's going to ask them in a moment. So, as soon as you get questions, as soon as questions come to you, put them right in the Q&A, and we'll take a look at them. I wanted people to let us know where you are coming from here in the city. Part of the interactive, if you could just put in the chat like what ward you're from. And if you're not from Newark, you could put whatever town you're in as well, just to say where you're from so we can get an idea who's watching today. So again, this is the complete home buying experience. It's the guide for making the biggest purchase in your life. So I just want to share my screen. Tracy, can you see the presentation? All right, great. So, before I even start, one of the reasons why I wanted to do this webinar is as soon as, we launched the land bank, we started getting a lot of calls from folks asking not only about the land bank, but, how to purchase a house themselves. They didn't know the process. They didn't know, the first steps to take, and they just wanted a little bit of help, things that aren't taught in school. So we wanted to deliver this information to you guys. And, also, due to COVID, we all know that what's going to happen, in a few months. Unfortunately, there's going to be some opportunities out there where, in the housing market where current homeowners and landlords, will need to sell their property. So I feel like people should put themselves in a position to take advantage of the opportunity, not take advantage of other people or their misfortune, but the opportunity itself, because many times opportunities come our way and we're just not ready for them, and we can't take advantage. So I think we should be able to get ready now. And a little bit about my background before I jump in as well. I'm an architect. NJIT graduate 2005, EOP 2000, worked at different firms throughout Jersey and New York, transitioned to a project manager for a developer and slash owner, a property owner in Jersey, which brought me here to Invest Newark. Basically, I've always had a hustler mentality, entrepreneur mindset, always thinking about how to make a dollar. And, I never wanted to be comfortable with, working a 9-to-5, never wanted to be reliant on a regular job. So, after graduation, I started in some network marketing businesses, like Amway, Cutco, with the knives and things like that, Prime America, all that stuff. Say what you want, but I learned a few things from some successful people. And one of the things, one of my mentors, what I learned from him is when he was actually talking to a realtor and he asked, how are you a realtor, but you don't own any real estate yourself? So I took that as a challenge for myself, thinking that, I'm an architect, why don't I own any architecture, right? Or, properties, house, or anything like that. So shortly after, I purchased a multifamily house, actually right here in Newark, became a landlord. Years later, started doing some flips, and, been part of a few closings, I would say. I've bought about 5 properties, been a part of 5 purchases, 4 sales, and 2 refinances. So a total of 11 closings I've been a part of. And just saying that, just let you know that I do this in real life, and so this is some experience information that I'm going to be giving to you guys tonight. Because I love to share knowledge, and I like to help people come up, because that's what happened to me, and so I want to give back as well. um because a lot of times people put buying a house on a pedestal, right? So it's really high, it's up here, I can't reach that, I can't achieve that, but it's really not that hard. Someone actually told me that it's actually not hard to buy a house, which changed my mindset. So it's one thing that you should stop telling yourself that if you're thinking that. Many people I talk to don't know that you can buy a house for only 3.5% down. You don't need tons and tons. You don't need thousands and thousands of dollars to purchase a house. And another thing people don't know is that you can actually get approved for more money when you're purchasing a 2-family or 3-family house versus a single-family house. A lot of people don't realize that. So, with that, I'm going to jump right into the PowerPoint now. And disclaimer, I am not a realtor, not a financial advisor. This is not financial advice, real estate advice. Before you make any real estate purchases, do your own diligence first. All right. So we'll jump right in here. This slide just goes over some of the past real estate webinars we've had, which we found on our website. We've done land bank, home ownership and closing 101, permitting and zoning process, funding financial real estate deals, working in construction, the labor union training process. Our website is here, and our email address, and you can find us on many of the social media platforms out there: Facebook, Twitter, LinkedIn, YouTube, Instagram, all of that. We might even be on TikTok now. Not even sure, but you can find us on those platforms. So, buying a single family house. Step 1 is obviously from the image that you see there is saving money. You see the different jars there. So number 1 would be to save money. Buying a house is most likely the biggest purchase you'll make in your life. You'll have a lot of out-of-pocket costs to get the keys, right? So a couple of things that you have to pay out of pocket include a down payment assistance, down payment and earnest money deposit, which for FHA, which is a first-time home buyer loan, requires 3.5%. Conventional loan is between 3 and 20%. 20% is most common and easier to get approval. Then you also got your VA loans, which are for veterans, where there's actually a 0% down payment. And the earnest money deposit is your initial check that you give your realtor when you're first putting your offer. So for instance, if your down payment is $7,000, your earnest money deposit could be $1,000 personal check that you give to the realtor. The realtor will make a copy of the check and attach it to your offer and send it over to the seller. If the seller accepts your offer, your check gets sent to the seller's attorney, where they deposit it into an escrow account. Once you're under contract, that's another term we'll go over. The other $6,000 would be due and sent to the seller. Next is attorney fees. So with attorney fees, you'll need a real estate attorney to review the contract and negotiate with the seller's attorney. They also handle a lot of state and county paperwork filings. This cost varies between $800 and $1,500. Most attorneys will allow you to pay this at the closing. Next is home inspection. So, this is the most expensive purchase of your life. So it makes sense to have a professional take a look at it and inspect it. So the inspector, he's going to come through and he's going to check the whole property and the house for any, from the basement to the roof for any issues. They are usually super thorough as well. They're always looking in cracks, crevices, corners, everywhere to see if there's any issues. You should schedule the inspection at a time where you can be there. It's important that you're there so you can see if there's any issues that the inspector points out. All of their findings, good and bad, will be given to you in a report with their recommendations. Your attorney will send the report to your seller, and the seller will have a letter as well stating what repairs that the seller will make. In most cases, the seller will offer a credit for these repairs instead of spending money at the time to make them. And credits are good. If you get a credit from the seller, in most times I would suggest that you take it because it actually gets deducted from your closing costs. And so this cost, it varies depending on the size of the property, usually between $450 and $850. Next is appraiser fees. So the home, the home you are purchasing will need to be appraised by the mortgage company so they know the market value of the property. You have to pay this appraisal since the bank is lending you the money. A few things can happen here. So one, the house appraises at or above your offer. If this happens, you're good to go, nothing to worry about. And you're pretty much straight there. Or on the flip side, if the house appraises below your offer, the seller will need to make a decision. Since the bank will only lend up to appraised amount, the seller will have to decide whether they reduce their sell price or do they request for you to come up and make up the difference in price. So, your offer was, 300,000 and, the appraisal came in at like 270, let's say. So you got $30,000 gap. So it's either the seller lowers the price or you're going to have to come up to meet at that offer price. And actually, that actually happened to me a couple of times as well. And we ended up having to walk away from a few deals. So now is the home inspection. You will need home insurance. I'm sorry, homeowners insurance. You will need homeowners insurance before you close. You can contact your car insurance provider to see if they offer home insurance. Most large companies do, but also check local companies. The cost varies per house. Size, depends on it, as well as locations and different features. I suggest that you get like 3 to 5 quotes so you can pick the best price. There also be miscellaneous costs as well. These things can be like unforeseen costs that pop up. For example, your home inspector might find an example and evidence that there's an underground oil tank. So if that's the case, it's highly recommended that you conduct an oil tank sweep. That cost can be between $350 to $500. And if an oil tank is found, you can request the owner to remove it. However, they're not required to. This is one of the things people go back and forth with, but they're not required to unless there's contamination. So if the seller does not want to remove the oil tank, you can conduct a soil sample test as well. A soil sample test where a testing agency comes out, they'll bore like a couple holes around the perimeter of the tank that's underground. Even if it's in like a driveway, they can still put their drill into the driveway, and they can get the samples from that. And this cost can be between $400 and $800. there was also a case where you need a professional opinion for an architect or engineer before you move forward with the purchase as well. There could be like a structural issue with the roof or a structural wall that you need someone to look at. So you can always, reach out to an architect or engineer, and consultation fees vary, but it could be between $100 to $300 depending on the time that's needed. Next is closing costs. So this is the largest and hardest cost to actually predict. The closing costs would be the money you will need to bring on closing day to get the keys to the house. This cost varies because it includes the property taxes for about a 2 to 3 month time period, if not more, and some title fees. An estimate would be about 4 to 8% of your home purchase price, but there's a way to lower those costs, and we're going to discuss those later in a webinar. So on to step two. You'll see, you can probably guess from this image that step two is about credit report and credit score. So checking your credit report and your credit score, very important. And as Jay-Z said, what's more valuable than money? Credit. So there's some sites that you can go to check, your credit report and your credit score. Are listed here: annualcreditreport.com, Experian, Equifax, TransUnion. Those are the credit bureaus, and those will give you your report, but not your score. You can get your score by signing up to one of the other sites like Credit Sesame or Credit Karma. Credit Karma gets like a bad rap because some people go check it and it'll show you have like a 750, and then you go somewhere to apply for something and they're like, oh, you're declined. You're really at like 625 or something like that. So, but it's a good source just to check on your credit, make sure nothing's hitting your report that you didn't apply for. And to get approved for a mortgage, you need a credit score of at least 500. So a lot of people don't realize that you can get a mortgage with a credit score as low as 500. And if you got a credit score that's over 500, just type yes in the chat real quick. Hopefully we get a lot of yeses in the chat. But for an FHA 3.5%, you need 580 minimum credit score to get the actual 3.5%. So you can actually qualify for a mortgage at 500, but it's probably going to be harder for you to actually get approved. You might need a co-signer or whatever. But I don't know who's really going to co-sign for someone with a 500 credit score, but to each his own. Also 620 to 680 minimum for a conventional or VA loan. And another thing that they look at is your debt to income ratio, or DTI. 50% is the highest DTI ratio a borrower can have and still get qualified for a mortgage. Ideally, lenders prefer a debt to income ratio lower than 46%, and no more than 28% of that should be going towards a mortgage or rent payment. So here's the formula for how they calculate your DTI. You take all the bills you pay monthly, including your rent and mortgage, and everything that's on your credit report that shows up. They take all of that and then they divide it by your gross monthly income. So for example, if you make 50K a year, your monthly gross is 4,167. If so, then your monthly bills are 2,200. You then divide the two and you get 52%, which is too high. You're going to need to be around $2,000 a month with your debts to get a debt to income ratio 50% or below. So try to keep your debt very low. And then lastly, interest rates. That's one thing that credit scores also affect, is your interest rate. Right now, mortgage interest rates are low. You probably hear about that in the news. Somewhere between 2 and 3% is like the lowest right now, if not lower. That fluctuates with the market and with the government and all that stuff. But right now is a good time to apply for a mortgage because the rates are really low. So moving on to step 3, getting pre-approved by a lender. So if your credit score is in approval ranges, you can get pre-approved for the mortgage. Most realtors will ask for a pre-approval letter before they submit any offers or even start working with you. This is so they don't waste their time since they are paid by commission. You can go to the bank that you that you have accounts with, and or a local credit union, or you can shop around online. A tip of mine is that if you're shopping around locally, you can actually print your credit report and bring that along with you if you're going to different banks or whatever in your in Newark or in your town. And that way, every place you go to, they don't have to run your credit where it affects your credit as they keep running your credit. So you can print it out and take it along with you. Now, keep in mind the pre-approval is not the final approval. You'll still need to submit a bunch of paperwork before you have the final approval. This means that once you have an accepted offer in a house, then you'll get the final pre-approval. So before you get that final approval, make sure you don't make any new major purchases. Try not to miss any payments on like credit cards or whatever, and don't open any new credit cards either. Don't open any new credit in general, and try to make sure that your bank account is in good standing too, because the mortgage companies, they ask for statements for your bank account and things like that. And also, maxing out your budget. You don't want to get max out your budget just because you get approved for, let's say, 300,000 doesn't mean you have to buy a house for 300,000. You can get something lower so you don't max out your budget. Your loan approval amount also varies depending on the property type you're looking to purchase. A pre-approval for a 2-family home will be more than a single-family home because they take into account the second unit's anticipated rent as your income. Same with a 3 or 4-family home. Instead of just your income, they're going to calculate with an additional 1 to 3 other income sources, in their pre-approval amount. So you might get a pre-approval for like $275 for a single-family house, but for a 2-family house, you might get approved for like $350 because they take that other unit and they add that rent to your income. And so with the type of loans as well, I'm getting a pop-up here on my screen. Give me 1 second. All right. So with the type of loans that are available, we'll start with the FHA. So for the FHA, which is also called the first-time home buyer, it only requires 3.5% down payment. So for an example, if the house is $200,000, that's only a $7,000 down payment. For a house that's $300,000, it's a $10,500 down payment. So you're not really, a lot of people think that, to buy a house, you need, $40,000, $50,000 saved up, to purchase a house. But if it's your first house, you can do an FHA loan and only have to put 3.5% down. Also, the credit score, as I mentioned before, 580 credit score for the 3.5%. And that applies for single family condos and 2 to 4 family houses. FHA has other requirements too, like the condition of the house has to be habitable, no health or structural issues like peeling paint or loose steps, loose railings. There will be a FHA inspection from the bank. This is separate from your home inspection. And if things are not up to their standards, they will provide you a list of required repairs that you will have to ask the seller to fix in order to get final approval. This is why some sellers will not consider a FHA buyer, because they don't want to make any repairs. So keep that in mind when you're shopping. PMI. So since the down payment is less than 20% with the FHA, the lender will add something that's called private mortgage insurance, PMI, to your loan for the full 30 years. The PMI costs between it's a 0.5% or 0.4% to 1% of the mortgage annually, and is usually included in the monthly payments. So this is like insurance for the lender. Since you're putting less down, they add this to your mortgage payments. Hey, Tracy.
Roger, quick question.
Yeah.
So for the FHA loan, do you mind explaining to anyone, is this available for investment properties, or does this have to be their primary residence?
So FHA, you have to live in the property. So you can purchase a multifamily house, which is an investment property, but you have to live in one of the units. And if you already have a house, or if you're just looking to buy a investment property, you probably won't be able to get approved for the FHA loan. So jumping back to the PMI, the mortgage insurance can, no longer be canceled. There used to be a point where you only had it for maybe 5 to 7 years of your mortgage. But now that option has been taken away, where now it lasts for the full 30 years. So the only way to actually get rid of the FHA is to do a down payment of 10% or more, or you can refinance into a non-FHA loan. Next is the 203K loan, 203K FHA loan, which is also called a construction rehab loan. So this is good for actually what we're doing here at Invest Newark with the land bank. For properties that we're selling, structures that we're selling that need to be rehabbed, FHA 203K loan would be the perfect loan for it. So I'll explain that basically for a house that is inhabitable that you're looking to buy as a first-time home buyer, it has structural issues, health issues, etc. It's in a nice neighborhood though, and so you really want the house, you love the house, you want to move forward with it. The 203K loan is the loan that you need to look at. It has the same requirements as a regular FHA, except you can make a list of the repairs, and you can get a contractor to give you a proposal to fix them, and then those costs can be included in your loan. So for example, if a house is $200,000 but needs $50K in repairs, and that's the quote that the contractor gives you, and you submit it to the mortgage company, the mortgage company will then give you the mortgage for the $250,000. So 200 to purchase the house, and then that 50,000 would be set aside for you to do the renovations. Now, keep in mind, you can include like kitchen and bath renovations when you list of repairs, but it is limited a little bit, for like, doing additions or finishing basements, or, having big walk-in closets or shoe closets or something like that. Those might not get approved, but, you just always want to check with the lender. And also there's going to be the FHA inspection for the 203K loan as well. But the inspector will keep in mind that the house is in need of repairs, so they will not require the seller to make any of the repairs they find. It will be listed under your contractor scope of work. Next is conventional loan. So this is the standard loan for mortgages. It requires a down payment of 3% minimum, but those have higher requirements to get pre-approved. Typically 20% down will be needed for approval. It can be used for single family, condos, co-ops, 2 to 4 family houses. If you get approved for lower than 20%, a PMI will be added to your loan. The interest, the insurance cost is based on down payment amount as well. So for example, I have a chart that I'll show you where you'll see by just putting 10% down, the payment goes up $95 a month, then $143 when only 5% is the down payment. So I got this from consumerfinance.gov website. So you'll see scenario 1, 20% down. There's no PMI, your mortgage payment is $764. Scenario 2, 10% down, your payments have gone up to $859. So, almost $100 more and $75 PMI. And then scenario 3 with 5% down, you'll see that your monthly payment is now $907. It's gone up like almost $150 from scenario 1, and there's $116 added to the PMI amount. And then you can see also in the 5 years, the difference from $30,000 to $43,000 that you're paying an extra $13,000. Also, I've seen piggyback loans. They call them piggyback loans. Those are used to eliminate PMI. This loan uses a conventional loan as the first mortgage where for the 80% of the purchase price, and at the same time, a second loan for 10% of the purchase price, and then your 10% cash down payment from the home buyer. So the combination of both these loans can help you avoid the PMI because the lender considers a second loan as part of your down payment. Next, we have VA loans. VA loans help service members, veterans, and eligible surviving spouses become homeowners. The loan has a home loan guarantee benefit and other housing-related programs to help build, buy, repair, retain, and adapt a home for your own personal occupancy. This loan helps you purchase a home at a competitive interest rate, often without requiring a down payment or private mortgage insurance, PMI. Some requirements include your length of service, your service commitment, duty status, character of service. All of those determine your eligibility for specific home loan benefits. You must have satisfactory credit, sufficient income to meet the expended monthly obligations, and a valid certificate of eligibility. VA guarantee loans are available for homes for your occupancy or a spouse and or dependent, if you're an active duty member. So step 4 is finding a real estate agent. So a good realtor will help you find a home by sending you listings of properties and by helping you negotiate with the seller at the service level. You can search online for realtor brokerages in your area, or find a boutique brokerage as well in your town. One tip that I would also say is that I would avoid using listing agents as your agent rep, because it could turn left. The agent just wants to make money, really, and they represent the seller. The seller is the one actually pays the agents. So there's a chance that they won't always have your interest in mind as the buyer. Not all the times, but I've seen it happen many times before. Interviewing your realtors is important too. So you want to ask your realtors questions before you select them. Ask about their experience, if they're full or part-time, are they familiar with the area you're looking to buy, what price range you can expect to pay for what you actually want, and they can tell you if it's reasonable. And once you have a once you have a realtor selected, you want to be straight up with them, and be upfront, and they'll be able to help you better that way. for the price that you want, and they'll advise you if you're actually, in the ballpark of what, the market is going, the trends the market is doing. So step 5, you're going to start looking for homes at this point. So this is like where you start having fun. You start going to houses, open houses, and visiting houses and things like that. During my time where I was looking for a house to live in, I probably looked at maybe 50 houses throughout Essex County. That was a little bit too much, but hopefully that doesn't isn't the case for you. You can find a house rather quickly. So your realtor is going to send you a list of homes. You can also look yourself. There's websites such as Zillow, Trulia. In New Jersey, you got gsmls.com, njmls, and you got realtor.com, Redfin. Those are some of the popular websites. One thing I like to do is search for homes a little more than my budget as well. So, from that list, I like to see if any of the houses have been listed for 90 days or more. This could be an opportunity where the seller may be desperate to sell. You can make a lower offer that fits your range. So if your budget is 300,000, but the house is listed for 329 and it's been on the market for like 4 months, the seller might take 300,000. You never know. It's a business transaction, so don't be afraid to offend anyone with your offers. Step six is making an offer. Once you find that the home that you love, you're going to submit an offer ASAP, because this market is crazy right now. Your agent will advise on how quickly the offer needs to go in. Some houses have so much interest, the listing agent makes a deadline for offers to be in by. You can ask your agent to ask for how many offers have been submitted or rejected, but the other agent can't tell you the price of those offers or how much you need to offer to get the deal done. That's just unethical in real estate. So the price is not only thing that helps you get an accepted offer. Offering terms, not just price. You can make an offer more appealing by offering different terms, like waiving the home inspection, which I actually don't recommend, but I've seen it, especially during this pandemic. You can also offer a quicker closing time frame. A typical closing time frame is 60 days from the day that the offer was accepted. So you can reduce that to 45 days or 30 days or whatever. I've seen some people write letters to the seller expressing their love for the house and how they'll take care of it with their growing family. So you never know what'll work. In a hot market, don't be surprised that there are multiple offers on a house. In this case, you want to come strong with your initial offer. The seller usually takes all the initial offers and selects the best one, or they contact the buyer's agent and inform them that there are multiple offers, and they set a deadline for your best and final. If you love the house and you don't want to lose it, what do? Do you overpay for it? This is a decision that you have to make. So you can offer as much as you want over a list price. However, keep in mind what we discussed earlier about the appraisal. If the house appraises lower than the offer, so it's best to discuss with your agent what's the best strategy in those situations. Seller's concession. So I mentioned earlier about a way to lower your closing costs, and that is with the seller's concession, which is having your seller basically pay your closing costs. To do this, you would need to request it during your offer period. The term you want to add is called a seller's concession. So with the seller's concession, you want to ask the seller to pay your closing costs. Typically, you'll ask for, say 10,000 seller's concession towards your closing costs. Now, you might ask yourself, why would the seller give me $10,000? You know, they are, but they aren't at the same time. So the concession, it comes out of the purchase price. So the best way to present this offer is that if you're offering 10K for your closing costs for the concession, um, you want to offer 10K more than your offer, right? So for example, if the offer is 300,000, if your real offer listing price is 300,000, make the offer 310,000 with 10,000 going towards seller's concession. So that way, that 10,000 will actually be paying off your closing costs, and the seller still walks away with 300,000. So when you submit your offer, the seller may not say yes or no right away. They may send a counter offer, which is great because they want to negotiate. So after a little back and forth, your offer will be accepted, and now you're in attorney review period, which is the next slide. Oh, and a tip here. So keep in mind that your accepted offer could change as well in your favor, benefiting you when you start the due diligence process once you're under contract. So attorney review. Once your offer is accepted, the contract is sent to each party's attorney for them to review the legal content. You know, and what's mostly contested in this is like where the escrow and down payment deposit is held, or if there's like an oil tank or something like that. This technically is supposed to last only 3 days, starting from the day the attorney received the contract. So follow up with your attorney to make sure that they are on it, right? After the legal dust settles, you're now going to be under contract. You also want to remember, you know, that you're at the pre-approval stage with your mortgage, right? So at this time during the attorney review, your lender will be asking you for more info so you can get the full approval of your loan. So work with them to get that part out of the way. Step 8, under contract. So this is where your due diligence process starts. You know, you're going to want to schedule your home inspection and your appraisal as soon as you can, because it's very important, you know, not only negotiation, but also to get to the finish line. Try to schedule the home inspection you know, at a time that you can go to it, and you want to pay attention. You know, this is the most time you'll get to spend in your new home until the closing. You get to go around, measure rooms, you know, figure out where you're going to set up, you know, your couch, your bed, where you're going to put the TV, etc. You know, your home inspection report can have items that the inspector recommends getting fixed. As the buyer, you can request these items to be fixed by the seller. You know, this is more of negotiations. The seller will either fix the items or offer a credit, or not fix them at all and just go back and forth, right? But you know, the credit, as we talked about before, which would cover the costs. So if a credit is offered, you should ask a contractor to give you a quote on the item to make sure the credit will cover it, or at least make sure that the same amount you agree upon. So, you know, for instance, say the inspector finds like a crack or something in the basement wall, and he says that he recommends for you to fix it. The seller might just say, oh, okay, I'll give you a credit for $500. Well, is $500 enough to fix what the issue is? Maybe it's a bigger issue. So maybe you should have a contractor go look at it first, and he can say, you know, how much it's going to cost. And then you can say, no, the 500 isn't enough. I need 2,000 or something like that. And, you know, you go from there until you settle on a price for a credit. Next is the scheduling your appraisal. The appraisal is equally, if not the most important step once you're under contract. The mortgage company, they're going to call to schedule this. You don't have to go to the appraisal. if you don't want to, unless if it's FHA loan, because they will point out things that don't meet FHA guidelines, which will also need to be addressed in order to close. The main thing is the assessment of the value of the house. The appraiser will pull comps, which are comparable homes in a half-mile or mile radius. They will go wider if they need to, so that way they can get the recent sale prices of other homes. So if the house is a 3-bedroom, 2-bath house, the appraiser will pull all comps that are 3-bedroom, 2-bedrooms, 2 bathrooms. And so for things to go smoothly, the appraisal, as I said before, has to come back valued at or above the offered price for the mortgage company to fund the full portion of the deal with no problem. If the appraisal comes back lower, you might be in for something, right? So you might start sweating a little bit because the lender will only fund up to the appraisal amount. So as I said before, either the seller will need to lower their price, or you'll need to come up with the difference by the closing date. And you need to mention this early. If it's possible for you to do it, then yes. If it's not, don't wait until you get the closing, and because then you end up losing your deposits and things like that. So you want to be upfront as soon as possible if you're not able to negotiate the seller down in price. You might want to just walk away with the deal so you can get your deposit back. And step 9, only 2 more steps left. We're almost there. Is getting your homeowner's insurance and setting up utilities. So homeowner's insurance is another requirement to close. You want to shop around online or locally to get the best price and coverage. They're going to ask you a bunch of questions about, all types of stuff about the house, what it's made of, the type of siding, what year was it built, what type of windows are there, stuff that you're probably not even going to know. So just do your best and, be ready for all their questions. Also, by this time, you will have your closing date. So you should call your local utility company, PAC&G, the water company, to make sure that you got lights, water, gas, on the day that you close or you move in, so you can schedule it for it to be converted over in your name. One tip is that if the house is vacant, I recommend hiring an exterminator to do a deep insect spraying in and around the house before you close. This could help get rid of some unwanted house guests before you get there. All right. And the last step is closing day, step 10. So now everybody is happy or excited, ready to pop some bottles, and a few days before the closing, the title company, that's doing the closing paperwork and calculations, they're going to send you the final amount that you need to bring to the closing, with any deductions that were taken or what have you. Even if you do a seller concession, there could be a little amount that you still have to bring, depending on how much the closing costs added up to. So you'll need to get this in a cashier's check from a bank. And once you arrive at the office, you're gonna start signing away, signing your hand off. They're gonna give you a stack of papers where you gotta just go to work, start signing away. But all that is all good, because at that time, you're gonna be ready to take a picture for the gram and, tag Invest Newark, because you bought your first house after watching our webinar. And, congratulations, you just got your keys. And that is all. I'll hand it back to Tracy for open up the Q&A.
Thank you, Roger. That was so informative and detailed that we actually don't have many questions. I think you did a great job of answering a lot of questions that people may have had. But at this time, if anybody does have any questions that Roger didn't answer or anything that if you could just submit your questions in the Q&A module, not the chat module, because there was a lot of interactive activity, so we may have missed them. If you can submit your questions in the Q&A, that would be helpful. The first question that we have is, how long does the process take? I'm assuming we're talking about from the time when you enter into the contract to make your offer until the closing day. So Roger, about how long does that typically take?
From accepted offer?
Yes.
Yeah, it's typically a 60-day process. You can request an extension at times. Say, for instance, if you didn't get the full approval on your mortgage, by the 60 days, you can request for an additional, 15, 30 days, what have you. It's up to the seller to accept that extension as well.
Mm-hmm. And a little earlier, we did have a question that I was able to answer in the chat, but I'll open it up to everyone. The question was, are you able to do a 15-year mortgage on FHA? So I'm not sure if these are public, if the responses are public, but Roger, I don't know if you want to open that up to all.
Yeah, so you can get a 15-year mortgage. I think 15 years is the lowest that you can get with FHA, but all of the loan types allow you to have less than 30-year mortgages.
Yeah, and I just would like to point out that it's the shorter the term, your monthly payments will increase. So if you do a 15-year mortgage, you're going to have higher payments than if you did the traditional 30-year mortgage.
Yeah, it's true.
So sometimes it might actually make more sense to do the 30-year mortgage and pay a little more each month on the principal. If you have the funds to do so, if you pay it down and then you can finish your payment sooner, but at least that way you're not locked into a larger payment each month.
Yep, that's great advice.
Roger, does the PMA last throughout the life of the loan? If so, does the amount change during the duration?
The PMI does last the life of the loan now. What you can do though is that in maybe 2-3 years down the line, or whenever you're ready, really, try to refinance into a regular conventional loan. That way, the PMI is removed, and in some cases, you actually end up with a lower monthly payment for your mortgage.
Do you want to give a little more detail about what it actually means to refinance and about how long you actually have to wait before you can refinance?
Oh yeah, sure. So refinance basically is basically reapplying for a mortgage where, if say your circumstances have changed, say maybe your credit score has gone up, you're earning more money or what have you. When you apply, they're going to see that you are in better standing maybe from when you first bought. And so you can actually get a lower interest rate at that point. And so, if you do that when you have an FHA and you have the PMI, if you refinance into a conventional loan, that's why I was saying in some cases your mortgage payment goes down because, you got a higher credit score, you're making a little bit more money, and you're losing the PMI. So most cases, your mortgage payment goes down.
Thank you. I think you did such a great job that nobody has any questions.
Well, it's all good. We put our email address in the webinar earlier. I'm sure Tracy can or Hilda can type it into the chat as well for any other questions. Feel free to reach out to us, and hopefully everyone enjoyed the webinar. And like I said, this will be on our YouTube page as well as our Invest Newark website. So thank you all. Thank you all for joining.
Thank you, Roger.
All right. Good night.